watching Master Trader Live. Simple market analysis and education to help you make money in the markets. Join us live each week on YouTube and see past episodes at Master Trader Live. And now your show hosts, Greg Capra and Dan Gibby.
Good afternoon, everybody. Welcome to Master Trader Live. It's Wednesday. We've got another great show for you. We're going to be talking about trading opportunity of a lifetime. Of course, you had to have lived through the last month and a half or so, and maybe some want to jump out the window. Unprecedented drop in a short period of time from new all-time highs, where I guess the majorities were blindsided. I would say maybe everybody was blindsided. While, we said trouble was coming in January and even suggested that it was going to start in February to our subscribers, in no way did we ever imagine such a drop was going to happen. We were really just anticipating, one of your normal type of corrections. Maybe it would have been a little bigger than, the typical ones that we've seen over the last few years. But this one was one for the history books. And why I was saying, it's the opportunity of a lifetime. Now, this isn't to say that the market can't go down further. And it looks like it started to do that today. How far it goes down based on how much it's down already, the minor retracement. You might be saying, but Greg, that thing retraced 20-25% off the low, depending on what we look at. And, that's what the media is saying, and it's true. However, when you see where it fell from, the chart, looking at it, the chart, it really doesn't look like much. And this is why looking at percent changes or many options traders will say, hey, it's a high volatility rank. And without a chart, it's really misleading. As you think, wow, something significant happened. But the chart really puts it into perspective as to what happened. So what we're going to look at today is some patterns, right? We're price pattern traders to see where prices came from, where they came to, the amount of the retracement, historical patterns that typically would set up a move to the upside. And, with that being said, it is going to take some time to kind of repair the damage, as we like to say, and to flush out more of this, the news as to, hey, we're all, take the handcuffs off, unlock the doors, go outside and breathe, maybe even get a little closer to somebody, elbow, shaking hands and all of that. And, this thing will be in the past. And, so part of the good parts was, hey, this didn't start from a situation where, prior big corrections happened, not like this, but, extended corrections, meaning the economy was doing well. So the president likes to say things are going to get right back to the way they were, like tomorrow. Well, that's not going to happen. But based on historical things that happened in the past, where these type of corrections would last for multiple months, half a year, or whatever, well, maybe this one won't be just like that. But it's always a process of ongoing reading the tea leaves, the market internals, the intermarket analysis, and the price patterns and relative strength between the markets. So that being said, let's get to it.
Hey, good afternoon, Greg, fellow traders. And yeah, you just added that point that I was going to make, but you did it for me, which was, we don't know the future, but we're going to use our approach to take in the information, the patterns, and we will know how to react in the moment. And then we execute and manage in between.
Yeah. So much of trading in the markets, and we all want to know this, I mean, like, what does the future hold? And there's so much of this education that's out there that revolves around predicting the future. And while everybody will say, this is not the Holy Grail, that's what everybody's trying to say. I've got the Holy Grail here. that'll lead you to the pot of gold. And while that's what we want, we have to have, an objective method that, forces us to recognize what's happening, get out of the way, or, hey, jump in there. So,
right. And that's exactly what we're going to show today. Not only the turning points where our approach from the highs with the market internals, but the incredible bounce that we had at the lows, looking at our market internals and so forth. And now, we came to the day today a little bit on the bearish side just because of the sell-off. But yeah, we'll get into it in a few moments. But this is our approach to trading anything that moves. We're chart pattern, as Greg said, technicians. So everything starts with a high probability setup. And then it's those other characteristics that Greg mentioned, the trend, support and resistance, relative strength, what are the broader market internals doing, et cetera. And then we just enter and manage in between. Hey, a couple of you, if you can put your drop down where you're typing to us, to all panelists and attendees. Charlie, yes, it will be recorded. BC, yeah, we will show you some charts here in the PowerPoints. And then as always, we will we'll scan the live markets to show what you've learned today and look for opportunity. Our approach uses, Greg coined the term macro or techno fundamental analysis. And that's looking at market internals, intermarket analysis, and technical analysis. We'll show you that momentarily with some live charts. And then that just makes our pattern approach that much more reliable on whatever time frame you're trading. Everything we do applies the same to day trading, swing trading, or position trading. We just use different time frames and different market internals. This was the S&P monthly chart, just showing you just visually, just look at a couple prior sell-offs. I marked this one, obviously, the 2008, 2009 financial crisis. Look at this, folks. We went down 67 bucks. I mean, the market got cratered. And then, you can see how it's a monthly chart, so these are going to be slow moving. We aren't going to really use the monthlies for our analysis of trying to pick the bottoms here, but just wanted to show you, the speed of how this one fell. Record 19-day fall to bear market. So that was a historic, rapid fall. I mean, greater than the Great Depression, greater than the internet crisis, greater than 2008. And all, coronavirus, fears of recession, depression, bankruptcies, etc.
So Dan, that fell down to $67. Not that
correct.
It fell
Yeah.
$67. I'm just looking at where it actually fell from at that time. It was like at 157. So it went from 157 down to 67.
Correct. Yep, that's the low, 67. And I remember the Qs went down to like $20. It was crazy, and just crazy times.
So that at the time was about a 52% drop. We haven't fallen 52% yet.
Correct. We've had about 35%, had a nice bounce before today's gap. We'll obviously look at, we were, had a nice bounce, but we were still, I think, hovering around 20% down. So that's what we're talking about today. Is this a time to invest? Everyone wants to know. Is it too early? Is it too late? Let's continue. I want to show you the volatility. This is the S&P daily chart overlaid with the S&P volatility index. And it just shows you that when we have massive sell-offs, volatility, which the VIX it's measuring the volatility of 30-day out S&P options, and people look at it as a fear indicator. When the markets are falling, fear is rising. It closed at an all-time high when the markets were crashing a week or two ago, and that was a vital piece of information for our tradable balance.
So what Dan is beginning to show you, everyone, are our tools. Right? How do we make assessments as to market turning points? And the volatility index is one of them, to where we see that it's risen to such a high extreme, equaling the past, and it gives us some insight as to market bottoms.
And you know what? Maybe that would also be a good time to quote Warren Buffett or similar type of market approaches, including ours, that he says something like, look, when there's blood on the street and fear is at these highs, we are looking for opportunity. We are not looking to short at these extremes. So this is one tool, as Greg said, that says get ready to be bullish. Let's look at some more tools. Well, let's look at some history here first. Textbook says bear market is 20% down. That's where we are now. That's what I said. We had the 19-day record collapse. 16 bear markets since 1926, one every 6 years. Everyone knows we've been in the longest bull market run, I think, in history without a bear market. They last between 6 and 35 months, the average of 22 months, and I just pulled this off some research, and the market loses an average of 39%. Well, let's look at these. This is the current one. We were down 35% in 5 weeks, a record. We don't know if this is the bottom. We don't know, but we're going to continue with our approach and see. The financial crisis, there, Greg did the math for us, 59% right there. 48 and 86, that was obviously the Great Depression there. So how are we going to profit from the anticipated turn? It will turn, right, Greg? The market goes up over time, so it's a matter of what is the picture of the high probability turn going to look like. You hear in the news, they talk about a V bottom, a W bottom, a U recovery, L, or something else. I don't know.
One thing you always say, is it different this time? What's different this time is all of those other bear markets, they didn't start like this. They started slowly, meaning there was like, oh, what was that? You know, it's like, I'm not used to it, like a punch in the arm. Like, it wasn't like I just chopped your head off like this one. So in the past, what's happened was there was kind of like a topping sideways, a drop, a retracement, a drop. And it's kind of like, you know, what do they say? Like you put a frog in a heated pan, like because they're cold-blooded and before they know it, they're cooked.
Right.
Well, that's kind of like the prior bear markets in that it started slowly. And before you knew it, you know, if you weren't paying attention, you were broke. So this one just fell off the cliff. So the ones before ended with 30, 35% drops. And they were that climactic ending kind of a move where, you know, the majorities throw in the towel. Where this one kind of like just fell from the roof out of nowhere. Like you were looking out over the Empire State Building and enjoying the view and somebody went, and you know, you went flying off.
And it actually fell so fast that it made it a little difficult to get on without big stops.
Without chasing it.
Right.
Right. So the normal thing historically would have been, hey, retracement short.
Right.
Well, there was like this little stabilization and down it went. So it was different this time. And you did not have a situation where the economy was deteriorating over a period of time and getting, you know, longer term inverted yield curves. So it'll be interesting to see how it turns on. And one of the questions that, you know, I've thought of is, well, is this the start of the move? Or is this just, you know, some weird situation over some virus and, you know, everybody reacted, maybe overreacted to shut down the world? Maybe not. It was the right thing to do, and the recovery will be speedy. So we're kind of in a new world, so to speak. And, but the historical patterns, like what Dan's got on the bottom there, they will play out, and then we'll just have to trade them and see how it all turns up. But so let's continue.
And Greg, you know, when you were giving the introduction and the title of today's presentation, I actually was thinking to myself, you know what, and feel free to add that in as we're looking at real charts of what scenario would set us up, but you just said it. Hey, maybe the opportunity of the lifetime is to go short first before we're thinking long. Yeah, we don't know, but when we look at charts, let's keep that in mind of what we would like to see to take advantage of continued weakness. This is just going to give you some definitions here, and then we'll show you the current. Let me annotate this. Then we'll show you the current internals. This is part of our three-legged stool that we mentioned, market internals, spiders up top, sentiment. You see here, it's measuring how bullish or bearish what we call the wrong way options traders are, just because at extremes, they're loading up on either calls, which are bullish bets, or puts, which are bearish bets. So let's take a look right here. You can see that every time the market is ugly, they're down here loading up on puts, And breadth down here is simply just the McClellan oscillator, and we have our bands of overbought, oversold. So when these are in alignment, they've done their job. It doesn't mean to buy or short, but it means everything we do has to have a confirming signal on charts. So when we get these in alignment, they've done their job, and we're now, so they give us a great heads up. And I'll let Greg talk about them on this slide, because these were the current ones up till last weekend, which they haven't changed much in the last day or two.
Right.
So Greg, go ahead and tell them. So at the high, talk about just.
I know what it's all about, Dan. So this is what we presented to our subscribers at the end of last year and the beginning of this year. And so over here is where the option traders were started to bet that the market was going to explode higher. And it looked like it would do it, right? We're thinking, oh, the Dow will be at 30,000. Technically, the pattern said it was very possible. But we were saying, hey, these wrong way option traders, they don't get it right, 99% of the time. So the market dipped a little. It's hard to see because of the extent of this drop. Then the market went higher. And so they continued to increase their bets, highly leveraged, that the market, like with the ultimate certainty, this market's going to go up and they are going to make a killing. And so we're pointing out that, hey, if that's the case, you better be in the right things because breadth is deteriorating. So we're telling our subscribers that, and my exact quote, somebody's going to get hurt.
Right.
I said, somebody's going to get hurt here. It's not going to be me. And
meaning, folks, meaning that they're too bullish, and this was our warning of someone's going to get hurt.
Right. So the patterns weren't predicting it, but the breadth was deteriorating. The wrong way option traders they're all in. They just went to the ATM and took out the cash, said, hey, put it on my credit card. I'll be back in a week to pay this off and maybe buy the bank. No. And then this virus thing exploded on everybody's face and down it went. It was a little minor nothing retracement and then a collapse. And these attempts to buy on the way down just failed until we got this little breakdown failure. Yeah. And, so this is where we were last week. And so then the market's kind of churned there for a bit. But, one of the things is this was actually a positive, that breadth increased so dramatically so fast. Historically, that's a good sign to, foretell that a bottoming action is getting closer. And that's about where we are today, that, this next move down that appears to be underway could set up one of these bottoming bullish patterns.
And again, just to be clear, something I said earlier. So in this B area, these are in beautiful alignment of giving us a bullish extreme signal. And so they've done their job, but look at the pattern tells us when to go long. And there was no pattern here until Greg said we had the breakdown failure. And in our weekend letter, we said exactly that. We were giving longs, and we said because of the internals, and there was a lot of other more bullish patterns than the spider setup here. That's the incredible bear market bounce that we took advantage of, both in stocks and options.
Dan, let me answer
Sure.
this question. Prasad, if I said it correctly, and Prasad, change your drop down to all panelists and attendees so everyone can see it. And what he asked, I want to answer because this is what is normally thought of, but in this case was totally not true. You think people, institutions are smarter than you. Well, they have better research than you do. That doesn't mean that they're not affected by emotions, and sometimes the research is wrong. So they weren't selling. They were loaded over their eyes long. This is what this is telling us. This isn't day traders using options, betting that the market's going to go up. Those are institutional traders, the smart money. So all of their data was saying the market was going to go up. Now, it could have if this thing didn't happen. But historically, we know that when this internal gauge gets to an extreme and breadth is deteriorating, you better be in the right things, because something is not doing well here. And the boat, everyone's on one side of the boat. So it's kind of like a game of chicken. Who's going to hit the sell button quickest? And so they all would have, and maybe there would have been some kind of a breakout failure type of pattern, but that didn't happen. Right? They all got caught, and then they all had to unload, and that drove the markets lower.
All right, Greg, do you want to talk about how this gave you a heads up that you were?
Yeah. So when we were starting to get the internals giving us a heads up that something was wrong, right? I start to look at some shorter term information that would suggest a recession may be coming. And so these are yield curves where this is much of the very, very short 3-month against the 5-year. This is 3-month against the 10-year. And this is the 3-month versus the 30-year. And so the shorter ones were already inverting, which is like now institutions are starting, and this is where you start seeing, I guess, what you could call the smart money, are starting to bet something is wrong over here. And it's very weird that the markets are at all-time highs, and these institutions, somebody knew something, like those senators that were selling their stock that come out of that meeting. Well, you don't think that they picked up the phone to the lobbyists and said, hey, guess what? It's going to hit the fan. And these internal gauges are what tell us as individuals what the smart money is doing, right? So sometimes, one piece of information will say, hey, the smart money here is betting so big that they really going to, or everybody could get hurt. And over here, through the eyes of the bond market, this is saying trouble is coming. And the longest here just barely missed getting inverted. And then here we see, you know, the Fed now is pouring money into the system, the liquidity, and these are all improving rapidly. So the right things are being done, right? So you might hear, you know, the president, who's the cheerleader always, who has been saying, hey, we're doing all the right things. And, you know, you turn on, you know, Nancy or CNN and they're like, not doing anything right. Well, who cares what they're saying? Right? They're politicians. We look at the charts and we can see that the right thing's being done here. But we still need the patterns to historically occur that say, hey, the coast is really clear.
And that's what we're going to talk about right now. So that this is our advisory swing and options trader, where we trade stocks, options. We do directional trades. We do income trades by selling options. And Greg does the amazing market and sector review on the weekend in a video. And this is where we guide our subscribers, which are individual traders like you all, and all the way up to hedge funds, family offices, and they value, obviously, not only the trade ideas, but the advice on discussing these terms that we have just been showing you. These are now let's start looking at the patterns of what, how to just objectively look at something and what we might be looking for in the upcoming trading opportunity. These are the only possible things: a stock, ETF, currency, commodity, anything that moves. This is all they can do. So we teach how to recognize these. An uptrend is higher pivot highs, higher pivot lows, downtrend, sideways trends. And so once you recognize what those are, and then quality ones, etc., then you just need to know about, okay, what about when those trends break? And then you know what to do in every single market environment. Right now, where the daily charts, weekly and monthly, are still in downtrends.
Nice little add to the slide there, Dan.
All right, so here's our uptrend: higher highs, higher pivot highs, higher pivot lows. Greg will love to tell you, you know, trend changes done horizontally, not diagonally. You don't need trend lines. You don't need Fibonacci. You don't need oscillators. You don't need anything to determine what an uptrend is, or when that uptrend is broken. Common sense, we say, keep it simple, stupid, the KISS method. Whenever you have a break of major support, you've broken the uptrend. Does that mean we now have a downtrend? No, it doesn't. What is a downtrend? Well, lower pivot highs and lower pivot lows. Okay, so now show me when this uptrend becomes a downtrend. Well, when I have two or more lower highs and lower lows. It's that simple, folks. Now I'm in a downtrend. So that's up to down. Again, we fell so violently, you might not see these clean pivots from the prior highs, but this is what we're going to be looking for on a tradable bottom coming up in many of these beat up sectors and stocks. So step one, we want to trade above a prior pivot high.
Define a pivot, yeah.
Excuse me?
Define a pivot so they know what you're talking about.
And it's just where, and we can show you on a daily chart, but it's where prices pivot, where you have, I use 2, I think you use 3. So 3 or more lower highs to the left and right. And that's a pivot. That's a pivot high.
So Dan said he uses 2, I use 3, right? By definition, a pivot, how we teach it, is 3 higher low bars to the left and right of a pivot low. Now, if you are using a higher time frame, say like on a monthly chart, using 2 could make sense. If you're an intraday trader and you're using a 15-minute chart, 2 might make sense, or an hourly chart, because you're condensing the data, right? So you're not going to see the pivots. On a 5-minute chart, I use that as my intraday time frame. If prices are trending down, making lower highs and lower lows, that 5-minute time frame is what I utilize to determine a trend change, whereas this would happen. And so the major resistance area is a pivot, and then there was a lower low, right? So to break the trend, it has to take out that major resistance. And the reason why we say that you do not need to draw diagonal lines, that event will break the trend line every single time. So why do I need to connect dots and be concerned about, am I connecting the right dots, right? So if you want, watch the guy on CNBC doing this, forget it. Just do this, look to the left, right? And so when you have this lower high, lower lows, it takes out the high, you can buy the next higher low, but it's still making a bottom. As it creates or retests the next pivot that it makes, it's creating a larger bottom. And larger bottoms could be a head and shoulders bottom, right? I mean, W bottoms are a start. But the point is, as time goes by and that new support area is created, it supports a bigger move to the upside. So if we trade something that drops like a rock, right, like the market did, the likelihood of it going right back up again is probably about 0.5%.
Well, except for the bear market rally, which we profited from with our market internals telling us it was imminent.
That's different than what I'm saying. The move started here, new all-time highs. It ended there for the moment. So the odds of a collapse going back to here,
oh, right, okay,
is small.
Yeah.
Getting to here, right? Even like, let's clean up my doodles, right? So dropping here and coming up to here, which is in essence what's happened, right? The market went straight down, right? So to come back up like this,
he's showing here
25%, it's not a big deal, right? But to get back to here would be an amazing situation to do such a thing.
Right.
Trevor's asking me, do I watch CNBC? I turn it on in the morning to see what's going on in the world, sure. And when the guy comes on and he starts running his finger along there, I'm tempted to take pictures of it and post it on YouTube and say, this is what not to do.
All right. Here are the daily spies. I grabbed it this morning. Today we have a gap down, but that's fine. So the question, like we were saying, hey, is it too early, too late? Let's apply just what we've learned so far. This isn't a downtrend. We have lower pivot highs and lower pivot lows. This was a deep retracement, and it was going sideways until today, but it's still in a downtrend. Deep retracement, and we're going to be talking about our hopeful retest patterns in a moment.
Dan, there's only one pivot high in that whole drop. And it's one of the insights of the speed at which this move went down. It never pivoted other than right there. It never pivoted. And you didn't know that that was a pivot until that bar completed itself.
And just not to confuse things, but just to kind of support what you're saying about the speed, it doesn't even have two lower highs or lower lows on each side.
Yeah.
I mean, so look at this. It only has one to the left This one only one. This one only one. I mean, so that was quite a kicking there. USO, the oil ETF, all in the headlines. Has this collapse in global demand and the price wars, Saudi and Russia, perfect storm. But is there any pattern here to call? It's a monthly chart. Any pattern to say, oh, it's time to buy this? None. That's an ugly fall. So for long term, the answer is no. We need to break the trend. We need to go sideways, maybe a double bottom. There could be bounces on the daily and weekly chart, but that's a very ugly monthly breakdown.
Hey, I'm hoping that gas gets back to under $1.
Yeah. This is, I just grabbed the marijuana sector here. It's one that we follow. Another beat up one, $45 down to 10. Still in a downtrend. Lower lows, lower highs, declining 20 under the declining 50. There's no pattern here. So what do you tell people to do, Greg?
With what?
Right. Is this a long-term bottom? We have no idea. It's still just a bounce in a downtrend.
Right. No, it accelerated. I mean, this thing has been a toboggan slide pretty much to the downside, but you know, as prices begin to accelerate, and as a visual aid that we use the moving averages for, you can see how close together they were here, right? And actually, you know, kind of touching, not that we don't use moving average crossovers, but just to see that the distance between the moving averages are increasing. It's just a way of visually saying, you know what, the momentum is increasing. That doesn't mean the trend is going to change, but as prices, if they continue to go down, well, then you just know that the probability of a snapback is getting closer.
Right. So if they're right, so we still trade, folks, smaller time frame because we're traders. But I'm was making the point that there's no pattern here for calling a long-term bottom in the weekly chart right now.
Trevor wants to know why you're fixated on marijuana.
Well, when you're sitting at home, nothing else to do, doesn't that make sense?
But that went down the most, I think, last year. I mean, it's just been a steady decline. So you want to look for a downtrend to make an example, there it is.
Yeah, well, do you remember Tilray? And that's just a classic example of trading bubbles and people's euphoria. Tilray, after it came at IPO, whatever, $20, went up to 300. Right now it's trading for $6, down from 300. So folks, these are gonna, let's just focus on the M bottoms, because that's what we'd be looking for in these beat up sectors on the weekly charts. So we came down, Greg showed you the bounce and the spiders and many other things. And now today, we'll show you the real charts here in a few minutes. We have a bearish gap down, and we would love any one of these three pictures on anything that is beat up on the weekly chart, and then go drop down to the daily to get one of these pictures. These are all W bottoms, and we're just showing you three different flavors of them. This one is a nice potent 2-bar reversal. NL shock means it makes a new low and snaps right back. That's a beautiful pattern. We already know we have what we call a price void because of the rapid fall. So once we get our turn here, so Greg, you know what? Somebody might be asking themselves as a good question, since we define pivots as 3, because this isn't a pivot yet, folks, right?
No.
I have 3 higher low bars on the left.
No.
I only have 1 here, Greg. So how do you answer the question of somebody saying, well, guys, that's not a pivot yet?
Do you need a pivot to go long?
Well, that's what I'm saying. Somebody might be asking that question. But this is a potent reversal on this time frame. Made a low, snap back. It's in the air. It's on support. This one came down. This is what we call a deep retracement into resistance. And then I have my retest pattern. Can come in all different flavors. This one came down. This is what we call a potent reversal. Notice how it, closed over the high of 3 bars. And then it's coming back to retest it again. So buyers are stepping up. If we get any of these patterns on, like I said, we'll scan a few in a few moments. This is what we're looking for. And I mentioned in the green trading room today, because I remember Alex even and some others were saying, well, Dan, why do you think that's going to hold? And I said, I don't. I said, this is just if it sets up. This is the picture that we would look for. If it doesn't set up, I said, let's say we come back and retest these prior lows and it can't bounce, and we have some breakout failures and it's just going sideways, then sure, I said, we can take the short position. Jets, obviously the airline jets just got killed here, weekly charts. So now had a deep retracement. We're watching this sector to see if it can give us exactly what I just showed you. A W bottom on a smaller time frame, and just to give us a tradable bounce. Another example, climactic buy setup. This is just showing you how we use multiple time frames. We call it drilling down. So even though the daily is still in a downtrend, I do not have a W bottom. But for day trading or even swing trading, notice how we have a nice bounce on the hourly. And then 15-minute chart, we had a beautiful entry. So that's more of a day trader's entry and swing trading, just for a swing trading bounce. I see Greg answering a few questions. These are all bullish turns here, and we love selling credit spreads around these bullish turns. We had a huge week selling these high volatility put spreads when we got that turn last week that we showed you with the cooked internals. And if we get this new double bottom that I've been talking about, we're going to be doing this again. Once we get a turn, maybe here's what we call a breakdown failure. Here are 2, bottoming tail, breakout. What we do is we sell put options under support. We buy a further out of the money put, and money gets deposited into our account. And with high volatility, we get paid handsomely for this. So as long as the stock goes up, sideways, just chops around, we make that money through time decay and volatility contraction. So this is a strategy we teach and we love on selling put spreads around compelling turning points. Just showing you 2 examples here that were real trades for our swing advisory letter. Volatility was like 100%. It was the highest it was in over a year. Remember the chart of the VIX I showed you, closing at all-time highs. Disney here, still in a downtrend. I get it. There's no compelling pattern to swing trade this stock, but it was trading over $100. And we shorted the $65 puts for only 7 days of risk, $1.63 a share. And we said, you know what, we'll take Disney at a 35% discount if required. So we actually didn't have a stop. And despite the stock going against us, we still made full profit on that. So if you happen to sell a 10 lot, just to show you the math, $1,630 would hit your account. Home Depot also got beat up here, $250 down to $140. We got our bottoming tails. and we sold the $100 puts for $2.10. Just amazing high premiums in times of high volatility. This was a directional trade that we gave. So remember I said the spiders was not a clean pattern, but in many of these beat up travel stocks, leisure stocks, hotel stocks, we were finding compelling turns. So this is what we call a bullish 1, 2, 3 off the low. And folks, we made 100% on this in 3 days. That, as Greg said, when things get beat up so bad, it doesn't take much to get a huge return on a bear market rally. And that is it for our slides. We mentioned the green trading room is our live trading room where you hear us prepare for the market every day. Craig gives great market analysis. I review trade ideas, gaps, and you watch us trade and analyze the market, scan for new trading opportunities. We have a no-brainer 7-day, $7 trial. You can go to mastertrader.com/green trial. Finally, this is Greg's advanced technical strategies course. You heard us talk that everything is talking about compelling patterns, and Greg teaches the market internals and everything else in this full course. And as a special in times of this, what we think is going to be a fantastic trading environment coming up. Like right now, I see the market's breaking the lows. So for the short term, we're bearish right now for day trading and swing trading until we get these possible retest patterns that we're talking about. Greg, do you want to add anything?
It's getting late.
Okay. All right, so folks, we're going to give you 50% off of this course. Greg just posted the alert right there, but mastertrader.com student MTS. All right, that's it. Yeah, let's take a look at the markets. TJ is asking me, do you use current weekly options? Yeah, our weekly options trader, TJ, focuses solely on selling options that expire 10 days or less. Our swing letter, we trade anything in there, stocks or options. We buy them, we sell them. But even longer term trades, we rarely sell options greater than 30 days. How much weight overnight trading in the analysis?
I'll cover that. But Mark wanted to know about a trade that was stopped out.
Yeah, we stopped out of Apple today. I know somebody was asking about that.
All right, so we'll start with the spiders and answer to some extent Don's question. What Don is asking about pre-market analysis, not analysis, the data that's there. So one of the conversations that we had in the green room today was combining the day chart, 9:30 to 4 o'clock, and the 24-hour chart, looking at the futures versus the spiders. So with the spiders, you can look at overnight data. It's not as clean as the futures, but the one thing to do, and this is how you should trade gaps too. A lot of people look to fade gaps. It does work to some extent with the broader markets. Pretty much with stocks, it's going with the gap. But what you do is when it's gapping like this, everybody looks for the gap fill. Right? Well, this is a big gap. The odds of getting to the gap fill are pretty small. But what you should do is look at these reference points, right? The swings that it broke down through. And those are your reference points that you're going to want to sell against. Now, looking at the 24-hour chart, right? That can be of a help. So I always look to combine the 24 hours. So this was the overnight trading. These are just bad ticks here. But you see, this is lining up right up near the highs over here. So that's a good reference point where there should be a turn. So again, this is kind of like what we call the factory work of just saying, hey, what should I do to do this analysis? Well, you mark off those points, and the way prices had fallen, this is what I covered on YouTube pre-market, is that the way prices had fallen, you know, over hours down to here, and I said they're probably not going to, they're not going to just collapse here. And there may actually be a little
bounce,
gotcha kind of trade or a flush at the open, and then it would reverse back up again. And so it kind of did that. And I can remove this. It's hard to find the tools, Dan. Once you start, got to switch back and forth here. You know, it started to come down, and then that's where it started to move up into resistance. So you mark off your reference points by looking to the left. You don't need trend lines. You don't need VWAPs. You don't need GAN lines. You don't need oscillators. You just look to the left, and you wait for your setup to occur. And then you've got this little topping reversal in the red bar there. So patterns are one part of what we look at, right? So we look at patterns to say, hey, this is a reversal, however it's going to look. The other part is, what's the location? So this was a reversal. This was the beginning of a reversal, but the odds of this actually reversing were much greater because of the location where it's happening. So even if you don't have futures, you could look at pre-market data, you should be able to, but even without that, this is the process. With a stock or an index, look at where it gapped from and look at where these reference points are. And so now what we're looking for, and as we covered, is, let's clean this up. Ideally is to get a retest down here and have prices even take out the low. And the same slide that Dan was showing is then to get some kind of, he used the term potent reversal, which is just a big green bar after it breaks down. So, questions? Oh, you answered. Look at X-ray and square.
How do you see the W on the daily chart? We do not have a W yet. That's what we're saying. Right now, this is a bearish gap in the broader markets. And for swing trading, we look lower. I just showed you the W and M patterns, though. Those would be possible pictures that we're looking for.
Right, so this is what we're looking for it to come down there and then turn back up. Now it's in a downtrend. Maybe it just keeps going. We don't know. Right. See this big bar right here? Let's assume that this keeps going down over the next few days. And we get this. Now we're looking at X-ray here. I was looking at this saying, hey, that's still above its opening price. That's pretty good. Now let's just say it comes down there. And once it does get down there, you know, it does that. That's the picture that we're looking for. Something like that. It doesn't have to be exact. But look, we don't teach that this has got to be the pattern, right? It's bar by bar analysis. It's support, resistance, trend. And when you get a picture that's like, hey, that looks like the one, you do it. Because historically, that is a bottoming type of a pattern that works out well. And having a big green bar like that, ideally accompanied with some big green volume, And maybe you get a 1, 2, 3, but it should result in a move up. So we're looking for that type of a setup and a big opportunity to occur in these markets. Well, it doesn't matter. You know, I mean, the volume dying here, it rallied up and it's lower. What you're interested in volume is these spikes, right? Forget this for now, just forget it. If it falls, you know, see if you got the big volume spike. So squares coming down, lots of things are coming down. You can see the daily chart here. And so one of the concepts from the MTS course that you would learn is called the transition. What it looks like, understanding multiple time frames, the transition, in this case, from green to red. So that can form in different ways. Bar by bar analysis will guide you as to what's happening. And so now with square, right, same story. It doesn't matter whether it's square or the markets, that we get that big reversal day. So this one, I drew it so it went down a little further. And you'll notice that I drew it purposely to show that range contracting from the prior ranges, which means the downside momentum was beginning to slow. Right? Ken says these are good pointers that I'm using. I'm actually drawing them. I actually made them bigger. Someone asked Dan about how to change the mouse, and I said, let me go look. And so I did it on my mind too. And so it changed the pointers in Zoom here. But anyway, recognizing this pattern in alignment with the higher time frame, right? Everything, as I said, patterns are one thing. So if you think you're going to learn how to trade by reading a candlestick book, it's not going to happen. But by combining a pattern, and you don't have to remember the names, you just say, hey, this was a topping tail. This was a topping tail. It's getting close to resistance. And this went up a little higher. And we're still waiting, right? We were waiting over a few days to see, will it actually go down? Right? That's pretty much as we were looking at the broader markets. And the real tell, right? The spiders were showing a little weakness, but the real tell in the Qs were that it poked its head well above there and then came back in again. So it was a trap. It was a little shock pattern there. And so now, as it's going down today, you know, getting a little stabilization as we getting into the midday doldrums, but now it's in a downtrend. And so I'm not even sure that that's a pivot there. We could look on this chart. Yeah, there's a pivot and a little acceleration, but it's now trending down. So where's it going to stop? Well, we just repeat on a short-term basis, it could stop right there at 182. Right, so we've got an area. It's an area in here that should provide some support for the moment. But ultimately, what we really want is this to come down here or close to it. Any others? Is weekly potential bearish 1, 2, 3 on square?
Yeah, no, I answered them.
Oh, no. The bar is too big.
Right.
Right. You want a red bar and then an inside bar down at the bottom. Okay. All right, guys, that's a wrap. I mean, we could spend another 3 hours going through all of these ETFs, but I think what you'll find is, you know, I'm just clicking on a few here that you're going to see a lot of the same thing, you know, in different degrees that, well, it's gold. So many things are at turning points in software, which when you have this agreement between all of these markets, the odds are pretty good it's going to keep going down, right? What's the difference between MTS course and the swing course? Gap trading, much more detail in money management. Trader psychology is much more in depth. There's 50 different units within that MTS course. It's a huge course. So if you've taken the swing trading course, we give you a little bit more of a discount, toward the MTS, but check it out. We only give this offer, maybe at Christmas time, one other time during the year, but it's an amazing course that covers everything. It'll answer any question that you might have as to how do I interpret this pattern? How do I determine trends, trend changes, support, resistance, multiple time frames, trading gaps, a tremendous amount of information, keeping a trading journal. Check it out. Check out the site. All right, everybody. We'll be back next week with another topic, and hope you enjoyed this. And as I said, we'll be back. Have any questions, email us, Greg at Master Trader and Dan at Master Trader.
Good trading, everyone.
Thank you for listening to Master Trader Live. If you liked the show, we invite you to share this video on your timeline or tag a friend who wants to learn stock market tips. Stay educated with our free chart of the week, a weekly analysis or lesson sent right to your inbox. We're live every week, and you can subscribe to the channel and press the bell to get alerts. If you've enjoyed the event, please give us a thumbs up. Just visit mastertrader.com. That's mastertrader.com.